I think we can start this session with the first paper on the implication of CBDC for the monetary framework of central banks. This session is jointly organized by the ECB and the BIS. Please, the floor is yours. You have 20 minutes.
So I was just thanking the organizers. What I'm going to present today is very much work in progress. I'm looking forward to your feedback, also to feedback from our discussant. This is joint work with my colleagues at the Bank of Spain, Galo, Nuño, and Carlos Thomas. And so I should say that the usual disclaimer applies, and these are only our views and not the views of the Bank of Spain or the Eurosystem. Okay, so the motivation for this paper is the increasing attention from policymakers and academics on the topic of central bank issued digital currencies. As evidence, for instance, in this conference, the number of sessions devoted to this topic is quite large. And this also highlights that many of the implications of a central bank issuing a digital currency are still to be fully understood in areas such as financial stability, currency competition, financial inclusion, and many more. In this paper, we are going to be focusing on one particular area, one set of implications of CBDC, that is the implications on the operational framework of monetary policy. So before I start with what we do, I should probably define what we mean when we talk about the operational framework of monetary policy, even though I guess for the audience today, this must be pretty much clear already. But basically, central banks nowadays implement monetary policy through several instruments. These include lending and deposit facilities in which commercial banks can deposit their funds or borrow from the central bank. But since the financial crisis, other sets of instruments have also been implemented, including purchases of assets or direct lending to banks. So currently, and after the global financial crisis, central banks, at least in most advanced economies, operate what is called a floor system, which is basically a system in which the demand for liquidity from commercial banks in money markets is associated with excess reserves issued by the central bank, so that equilibrium rates in interbank markets are close or sit basically at the floor of the corridor that is given by the policy rates at which the central bank lend and borrow from commercial banks. So then, what would be the consequences for this operational framework of issuing a central bank digital currency? What has been argued, and we are going to show in the model, is that the introduction of a CBDC could reduce the level of excess reserves by basically reducing the demand for commercial bank deposits that would fly into these newly issued central bank digital currencies. And this could, in turn, affect the conditions in money markets, in interbank markets. So the questions that we want to ask, as suggested by the title and as I have introduced already, are what are the general equilibrium implications of CBDC adoption in a floor system for the operational framework of monetary policy? But also, what would be the implications of, so what the central bank could do to compensate for the fall in reserves to make conditions in money markets as before the introduction of CBDC? What are the implications of doing so with the different instruments that are available for a central bank? And also, what are the consequences of different designs? So considering the different design options that a central bank has when issuing a digital currency for the transmission of monetary policy. So in order to answer these questions, what we are going to do is that we are going to introduce central bank digital currency in a realistic model of monetary policy transmission. This is going to be a dynamic stochastic general equilibrium model, which is going to include several ingredients. And I'm going to be describing more specifically in a couple of slides. but it includes a banking system composed of heterogeneous individual institutions that can borrow from households, so they take deposits from households and then lend to firms. These banks are going to have heterogeneous investment opportunities, which are going to give rise to a OTC interbank market in which banks exchange funds among each other and also with the central bank. And this is the third point. So these banks can access the central bank facilities in order to deposit their own funds or to borrow from the central bank, depending on the regime in place. The model also is going to feature a central bank with all the tools available that were discussed in the previous slide, and households that have preferences for different liquid asset holdings that include physical cash and digital currencies issued by the central bank and commercial bank deposits. Then the model is going to feature all standard ingredients in a typical new Keynesian model that are going to give rise to the effects of monetary policy on real variables. What we are going to do with this model is we are going to calibrate it to replicate the balance sheet of the euro system and of the commercial banking system in Europe, and then explore what are the consequences for the economy of different scenarios in terms of take-up of CBDC and different design features. So I'm going to summarize the findings now, even though I'm going to be giving more details in a second. But what we find is that in the long run, the introduction of CBDC and substitution from households in terms of their holdings of commercial bank deposits for the digital currency that is issued by the central bank is going to decrease bank intermediation and increase equilibrium rates in the model. And without other measures, if the take-up of CBDC is large enough, this could lead the central bank. This could force the central bank to leave the floor system if the amount of excess reserves decreases in a large enough amount, and lead to a corridor system or even a ceiling system in which the interbank rate is given by the rate at which the central bank lends to commercial banks, instead of a floor system in which the interbank rate is given by the rate at which the central bank remunerates deposits from commercial banks. However, the central bank can avoid this and can preserve the floor system if it engages in asset purchases or direct lending to banks. And we are going to be quantifying what would be the size of these additional programs in order to preserve a floor system if the central bank desired to do that. We have some additional results, some results that are still work in progress, but the ones that I just described just now are the ones I will be focusing on, just in the interest of time. So in this slide, we provide an overview of the model. These are the different agents. The sizes, relative sizes, are not representative of our calibration. This is just for illustrative purposes. But we basically have households that save, before the introduction of CBDC, they save in the form of commercial bank deposits issued by banks here, and cash that is issued by the physical cash that is issued by the central bank. Now, banks combine these deposits with their own equity to finance the investment on firms in physical capital, and they also might issue, for liquidity purposes, they might also hold government bonds and central bank reserves. And these are the balance sheets of the government that issues these bonds, and of the central bank that holds bonds in order to with the proceeds raised from its liabilities. Now, very briefly, I'm going to spare you the details. I'm not going to show you the model equations, but just to give you a flavor of an intuition of the ingredients in our model. We model households as deriving utility from their holding of liquid assets above what they obtain in terms of remuneration for these assets. So we include the liquidity services of cash, bank deposits, and CBDC in the utility function. And importantly, these three assets are imperfect substitutes across each other. And this is in order to give rise to a positive demand for these assets, even though they might pay a different rate of return in terms of in pecuniary terms. Then the central bank is going to choose the interest rates in its deposit facility and marginal lending facility, and also is going to be purchasing assets and lending to banks, as well as issuing CBDC and choosing the remuneration rate. As I said before, we are going to have a continuum of banks that are going to be ex ante identical in the moment they borrow from households in terms of deposits, but then they are going to have heterogeneous shocks that determine their profitability in their investment to firms. And therefore, this is going to make banks willing to trade among each other, and also possibly with the central bank. So this interbank market is modeled as a decentralized OTC market. So there's going to be some search and matching frictions that are going to make some banks not able to find a partner in the interbank market. Those banks that do not find another bank with which to trade are going to go to the central bank in order to deposit excess funds or in order to borrow any desired liquidity. Then the consequences of this is that excess liquidity in the interbank market, so if there's excess reserves given by the size of the balance sheet of the central bank, for instance, is going to be what determines the position of money market interest rates within the corridor given by the deposit lending facility rate, the deposit facility rate and the marginal lending facility rate. So if excess reserves are large enough, most banks will be trading instead of among each other with the central bank, and the interest rate in the interbank market is going to be given by the deposit facility rate. We calibrate the model to, as I said, to replicate the balance sheets of the commercial banking sector and of the Eurosystem, the central bank in our model. In order to do that, we use forecasts to try to estimate what will be the policy rates and the balance sheet of size of the central bank in the medium term once the CBDC is issued. And for the elasticity of substitution between the different types of liquid assets, we just take values that have been used in the literature. But in the interest of time, I will not spend more time on the calibration details. Let me show you graphically what would be the effects of the introduction of a CBDC using the same diagram that I used before. So this is, as I said, the world before CBDC. Now, if CBDC is issued and households substitute some of their deposit holdings and cash holdings for this newly issued CBDC, then there would be a decrease in the asset size of commercial banks. But you can see is that in our model, first of all, they get rid of the excess reserves to match also the decrease in the reserves in the balance sheet of the central bank. And in principle, this doesn't need to have any effect on their lending to firms. But then, if the take-up of CBDC is large enough, then this might decrease completely the level of excess reserves, and then the operational framework of monetary policy would eventually turn into a corridor system in which the absence of excess reserves makes the interbank market rate to depart from the level that was given by the deposit facility rate and be determined in equilibrium somewhere between the marginal lending facility rate and the deposit facility rate. But then, if the CBDC take-up is even larger, and now deposits are not enough to cover for all the financial claims that are issued by firms in this economy, then this deficit must be compensated with central bank loans issued by the central bank, in this case in the marginal lending facility, for the banks to be able to compensate for this demand. So this would be, in graphical terms, the effects for the operational framework of this interaction of CBDC. Now, let me show you some of the quantitative details. So with the calibrated model, what we show in this slide is, in the horizontal axis, we have different levels for the take-up of CBDC as a percentage of GDP. And then we represent several of the endogenous variables in the model as a function of this take-up. So you can see as the take-up increases, the amount of excess reserves go down to a point in which, in our model, 10% take-up, so take-up of CBDC equal to 10% of GDP, would completely would make excess reserves completely disappear. And then at this point is in the point in which the interbank rate here moves to the center of the corridor given by the deposit facility rate and the marginal lending facility rate. Then if the take-up of CBDC is even larger, so excess reserves remain at 0, and then the central bank starts lending at the marginal lending facility to commercial banks, then the interbank rate now becomes the one at the marginal lending facility rate. And the central bank effectively moves from a floor system to a corridor system, and in this extreme to a ceiling system in which the interbank rate is at the ceiling of the corridor. But then the consequences for the real economy, as take-up of CBDC increases, the rate on retail deposits has to go up, and this decreases intermediation from banks. So bank loans decrease, and ultimately this has an effect on GDP and real variables. Okay, so in the last couple of minutes, I'm going to discuss what are the options of the central bank to compensate for this decrease in reserves and preserve the floor system. One such option is increase asset purchases. So here you can see this is the world in which the CBDC was high enough so that excess reserves turned to 0. Now, the central bank can purchase bonds from commercial banks in order to issue these additional reserves and preserve the regime with excess central bank reserves. So what we do in quantitative terms is to analyze to characterize what would be the level of additional asset purchases in order to maintain excess reserves at the level prior to the introduction of CBDC. And this is what we have here. So this is the level of central bank bond holdings as a percentage of GDP as a function of the amount of CBDC in circulation. So if CBDC in circulation would get as high as 30% of GDP in the euro area, then government bond holdings by the central bank would need to increase from 20% to more than 40%. So they would need to double the size of its asset purchases in order to preserve a floor system as before the introduction of the CBDC. And these two other panels, they illustrate the challenges of such policy, because at some point, central bank might even run out of government bonds to purchase if it wanted to preserve the floor system via asset purchases. Another option is to lend to banks directly in order to provide with additional reserves. So what we ask is what would be the maximum allowance on targeted lending operations similar to TLTROs currently implemented by the European Central Bank in order to preserve the reserves at their pre-CBDC level. And you see here that in a pre-CBDC world without this type of policy, one would need to go as high as 25% of GDP in terms of these targeted loans in order to compensate a take-up of 30% of GDP, and this would represent as much as 8% of bank total assets in the euro area. So I will just conclude. We have different exercises that, in the interest of time, I will not show today, that are concern different design options of the CBDC. We also have different calibrations for different scenarios with negative rates and a zero lower bound, or even in a pre-crisis corridor system. But unfortunately, I ran out of time, so I will just conclude. I presented a model of CBDC in which we can characterize realistically the channels through which monetary policy is transmitted through the banking system. We showed that CBDC decreases bank intermediation and the aggregate excess reserves, and we analyzed different policies that are aimed at preserving the floor system, assuming the central bank would decide to do so. So this is it. Thank you very much, and looking forward to the discussion. Thank you.
Thank you. Now we leave the floor to the discussant, Smets.
Well, it's a great pleasure to participate in this session, and I've enjoyed very much reading and studying the paper. Obviously, any comments expressed are my own and do not reflect those of the ECB. So what I'd like to do is first give a brief summary of the paper, and then basically make three overall comments. I mean, as you've seen, the paper develops a very rich model, which is based on this earlier work of some of the authors, to analyze the introduction of CBDC, digital euro, on the operational framework in the euro area. And in particular, it focuses on whether the introduction will lead to a fall in excess reserves that generates a switch from the current floor system, where the interbank interest rate is set by the central bank deposit rate, to a corridor system, where the interbank rate will be set in the interbank market and be within the corridor, or even a ceiling system, as Jorge mentioned, where the interbank rate would be determined by the lending rate. And the mechanism through which this impact will happen is very clear and very intuitive, and the model of the interbank market is really a very nice model, and has been used by the authors to address some other issues in the past. And the intuition is, of course, because of the substitutability between household deposits and digital euro. So when the demand for digital euro increases, then the demand for deposits, bank deposits, will fall, and this will give rise to a reduced demand for reserves by the banks, and a reduction in excess reserves. I think that the value of the paper is that it's rich enough to have a very careful calibration, and that suggests, as Jorge mentioned, that a demand for digital euro exceeding 10% of GDP could lead to moving away from the current floor system and relatively quickly go to a ceiling system. So these are important quantitative findings, I believe. In addition, then, the paper looks at whether other additional policies, like additional asset purchases or targeted lending operations, could be used to keep the interbank rate at the floor of the corridor. However, given the elasticities of the spread between the interbank rate and the deposit rate to excess reserves, which is relatively flat and which is based on some empirical work, this may require a very large increase of central bank balance sheet, possibly so large that it's not really implementable because it would distort government and bank funding markets. I mean, on this, I would say that, and again, you may have done it, but it's not yet reflected in the current draft of the paper. Some more sensitivity analysis could be useful to see how sensitive some of these quantitative results are to various parameters. And particular, the one sort of sensitivity that I think is important here is between the fall in deposits and the fall in reserves, which, I mean, given the structure of the model, as long as there's excess reserve, it's basically 1-for-1, which is not something, I think, that in reality we've seen. I mean, it's true, as long as the excess reserve, there will be more than, say, the reserve requirement ratio, which is only 1%. But we've seen from previous quantitative tightening episodes that, I mean, there is an increased demand for reserves, and so there may be less sensitivity there. And if that's the case, then this switch in the corridor system to the corridor system may take longer, and also the need for additional asset purchases may be less. So some quantitative, some sensitivity analysis, I think, here would be important. Now, for those of us macroeconomists that are interested, what does it mean for the monetary policy? I mean, in the end, not much, because the impact on the monetary policy stance is very limited, as the operational target that is assumed in the paper is the interbank interest rate. And so the operational framework will just adjust so as to implement the appropriate interbank rate, which is set by a Taylor-type rule. So in the end, this is really all these results about the nuts and bolts of how to implement the appropriate interbank rate, which is the operational target, when you introduce CBDC. I mean, the other part of the paper, and there Jorge didn't, he didn't have time to discuss this very much in the presentation, but it is quite an important part in the paper, is what is the impact of introducing CBDC or an increased demand for CBDC on the macroeconomy. And so what they find is that the introduction of an unremunerated CBDC, so a digital euro that earns 0% like cash, increases bank funding costs by driving up the equilibrium interest rate. This translates into higher loan rates, lower credit, reduction of the stock of physical capital, and aggregate output. Now, the main mechanism that is sort of highlighted and shown in the paper is what I call a wealth effect. So a low remuneration rate reduces the return on wealth accumulation and steady state wealth as a result. Again, these are mostly comparative steady state results, which ultimately is invested via the banks in the capital stock. And so you have a lower capital stock and lower credit and lower output. This distortive effect in household savings decision is increasing in the total amount of CBDC issued at zero. But they show that it can be addressed by raising the remuneration rate on CBDC. I mean, obviously, if the result comes from the fact that the return on savings accumulation is reduced, then by increasing the remuneration, you can offset that effect. These results, I think, they're kind of interesting. They're a bit intriguing, and they're not sort of so not the common reasoning that you hear about the impact of CBDC, and for that reason also interesting. But I think they would hold in a very simple model, too, where you don't have banks. So there's a little bit of a disconnect, I think, between sort of the macro impact, and then which is relatively simple and could be shown in a very simple, I think, real DSGE model, where you have a demand for cash or CBDC and some capital, versus the very rich model with a banking sector and a very rich interbank market that's needed to discuss the implications on the operational framework. So I think the second part is much more kind of interesting than the first part. I mean, the first part is also interesting, but it's a little bit overkill to have such a big model for this type of effects. Although the mechanism is very different, actually the calibrated effects on credit and GDP are quite similar to those of some other work. And they're not very large. I mean, they're significant, but not very large. I mean, in terms of overall assessment, I think this is very important work. It's very good work. It's very solid work. It's still a bit incomplete in terms of the draft of the paper, but it's going to be a very important paper in this growing literature. And of course, we know why, so I don't need to say that. Just let me say that also at the ECB, obviously, we have a sort of investigation phase going on, which is supposed to come up with the scope and the features of a possible digital euro towards the end of next year. And so it's very important to understand in advance as much as possible what the impact is on the macroeconomy and on how we implement monetary policy. So the comments basically have three. I mean, the first one I already mentioned. It's really about this mechanism behind the macroeconomic impact. So the authors highlight this wealth effect. So just to repeat, the fact that households switch from saving in the form of deposits to saving in CBDC, which is remunerated at a lower rate, results in a reduction in the return on household savings and at the aggregate level, and therefore in their wealth. And this wealth is ultimately invested via banks in the stock of physical capital operated by firms. This reduction in household wealth leads to an increase in equilibrium interest rates. And you see there the sort of the quantitative impact. It's an increase of 10 basis points when the demand for CBDC goes from 0 to 30%. And given the decreasing return of the capital stock, this leads to also fall in output. And it's of the order of 0.4% for an increase from 0 to 30%. As I mentioned, the higher remuneration rate on CBDC may actually neutralize this effect. And actually, if you do it even higher, then you may get positive effects from introducing CBDC. And I mean, this result runs counter to much of the common reasoning that you hear, which is about trying to minimize the negative output effect, particularly through banks, of introducing CBDC. And so one of the things, if you want to keep that part so central in the paper, I think it will be important to sort of highlight which are the features in the model that makes this channel the most important one. Because again, what people have in mind, and definitely what the first reading of the paper also leads you to think, is that there is such a thing like a portfolio rebalancing effect in this model. No, the households, it's true that they save through CBDC and cash, but they also accumulate capital. And so normally I would expect a portfolio rebalancing effect. If there's a bigger demand for CBDC, you should have a lower demand for capital. So I'm not sure, when in your balance sheet, why the capital is not there. Because, again, I thought in your model, the households are investing to build the capital stock. And so, again, then you would expect a Tobin effect, and which would be negative. But you don't seem to have it. So it was not very clear why this is not happening. A second effect, and of course that is very much discussed in many papers, is this bank disintermediation effect. Again, I don't think you have that effect, although no, there are capital constraints in the banking sector. And again, it would be important to sort of show why this, and maybe if you, what are the conditions to get that. And then third effect that has been discussed in literature is the seigniorage effect. No, so particularly when there's zero remuneration of CBDC, there is increased seigniorage. There's increased balance sheet, increased seigniorage for the central bank, which is given to the government, and so it relaxes the government budget constraint, and so it must depend on the effect of that. Must depend on what the government does with that money. Again, I suspect there is sort of required equivalence, and of course the taxes and some of the dividends are all lump sum, so maybe that's why there's not much happening there. But again, it would be important because it's a relatively elaborate DSG model to sort of highlight this a bit more. And particularly, what I would like to see is how this results of just focusing on this wealth effect, how this depend on two non-standard assumptions. One is you assume log utility. Of course, with the income and substitution effects, and only the wealth effect remains, which is non-standard assumption, at least in the quantitative DSG literature, not so much in the macrofinance literature. And secondly, the assumption that households cannot invest in government bonds. So it's only the banks that have bad sort of loan opportunities that invest in loans. Maybe again it doesn't matter because households own the banks, but again it's a non-standard assumption, and it may affect things like recording equivalence and the way in which households look through the balance sheets of the central bank and the government. I mean, the second comment, and I'll be very brief on this, is I mean, an obvious one. It may have an effect on GDP, but what's the welfare? So this paper analyzes the impact of a shift in demand for CBDC with an elastic supply by the central bank at zero remuneration rate. Alternatively, one can investigate what is the optimal supply of CBDC when there is an implicit demand for it. And this is something that we've done in a paper with co-authors at the ECB, Boulogne et al. In that paper, actually, the optimal policy is not to provide fully elastic supply of CBDC at zero interest rate, but to charge a negative CBDC rate to balance the positive liquidity services effect of CBDC with the negative bank disintermediation effect. So you want to have a tiering system. You don't want to remunerate CBDC. You want to penalize CBDC because of this. And again, so these results I mean, what is the mechanism will of course affect the welfare analysis, and would be interesting to understand how that works out in your paper. Let me not show you the results from our paper, just to say that there is kind of an optimal quantity. Of course, depends very much on the calibration. The model is somewhat different, but it's around between 20 and 30% of GDP, and it would have a negative interest rate. So obviously, there's then a question about how would the central bank actually implement that, and that's another issue. And then the last comment I have, and I'll stop, is but you mentioned that you've done it already, and it's not surprising because you did some of that work in the earlier JME paper. It would be very interesting, given this model with a heterogeneous bank and interbank market, to look at the impact of negative interest rate policy, because of course what it does lead to that those banks that actually lend into the interbank market will have negative carry, right? And so now this may not have direct impact on lending because they don't lend to the private sector. It's the other, the banks that have positive shocks that lend to the private sector. But obviously it will affect their net worth, and so it may affect their lending in the future. And so trying to look at maybe transition from I was going to say the current negative interest rate, but it's no longer current negative deposit rate to the steady state would, I think, be very interesting because of that. Thank you.
Thank you, everybody, for choosing this session and listening to my presentation. I'm a PhD student of the University of Basel, and I'm going to present this single author paper on central bank digital currencies and bank intermediation with heterogeneous bank deposits. So as the title says, the paper is about CBDC, and by now I guess the audience knows about what CBDC is. So I'm also thinking about a central bank digital currency that is a digital liability by the central bank that can't be held by the general public. So you can think of a retail CBDC basically. And also, as we've seen in other presentations, there is a caveat that if we introduce the CBDC, that it might have effects on bank intermediation. What's the line of argument here? Well, deposits are basically a cheap way of funding for banks, and if people see a CBDC as a substitute for bank deposits, then that could crowd out bank deposits, and then there's less funding, and hence we might have less bank lending, which might reduce credit availability and increase credit costs, and might have real effects on the economy. So the first research question then also is, does the introduction of a CBDC lead to the disintermediation of banks? And I answer this question by building a tractable general equilibrium model based on a new monetarist model in line of Lagos and Wright, and an OLG environment in line of Wallace. So obviously I'm not the first one to think about that question, so let me go to the main contribution of the paper and then also highlight the second research question. So when we think about the effects of a CBDC on bank lending, it might be important to think about the design choice of the CBDC. So for example, should we limit the amount that people can hold within the CBDC? Should we pay interest rate on it? And there is also discussion about should we choose the remuneration depending on the level of CBDC that is held. And also Fabio Panetta, who is a director in the executive board of the ECB, talks about this remuneration and then highlights that we should ensure that the CBDC is a means of payment that is as attractive as cash. However, we should maybe reduce the attractiveness of the CBDC as a store value. So it seems important to think about whether a CBDC will be used as a means of payment or as a saving vehicle when we think about the design. Also, Ross talked about that a bit in the presentation that we in the last session. So why is that important when we think about bank intermediation? Well, if a CBDC is mainly held as a payment vehicle, then it might mostly crowd out transaction deposits. However, if people start to hold the CBDC as a saving vehicle, then it might also crowd out saving deposits. And so far in the literature, this differentiation has not been made clearly. So I here want to contribute to build a model where banks offer two types of deposits, so liquid transaction deposits and illiquid saving deposits, where interest rates are set endogenously, and then analyze how the effects are going to be different. So that's my second research question. So how does the introduction of a CBDC differ depending on whether it is held only as a payment vehicle or also as a saving vehicle? And To get some analytical results, I'm going to solve the model analytically, and then I also do a calibration where I calibrate the model to the US economy. Let me give you a quick preview of the results. So with respect to the first research question, I here differentiate two cases, where the first case is very similar to what Jorge before mentioned, that I find that there is no effect on bank lending if the banks hold voluntary or excess reserves. However, if they do not hold excess reserves, then I find that bank lending will decrease. And with respect to the second research question, I find that if there is a preference shift such that 10% of the agents switch from transaction deposits to a CBDC, then bank lending decreases by 1.2%, and the effect is almost 3 times stronger if the CBDC also starts to crowd out saving deposits by the same margin. So, as I said before, there is already a literature on bank intermediation and CBDC. However, to my knowledge, I'm the first one who thinks about this difference between the CBDC as a payment vehicle and a store of value in combination with bank intermediation. In Jonathan's paper, in a newer version, they introduce time deposits. However, time deposits there, it's not like a crucial aspect of the model, and just pay a fixed interest rate. And as I said before, I kind of build a model where I endogenize these interest rates. So I'm going to continue with the model, but I'm just going to give you the basic intuition of the model for the sake of time. So there will be no math. If you want to see something that's, if you want to see something else, I have everything in the appendix, but for the sake of time, I'll just give you the basic intuition of the model. So in the model, there's going to be entrepreneurs. The entrepreneurs, they have an investment opportunity, and this investment opportunity has decreasing returns to scale. However, they cannot work themselves and have no endowment, so they somehow need to acquire a good that they can then invest. On the other hand, there are consumers, and these consumers are very important for the model. They have some timing friction because they can work when they're young, however, they want to consume later, and they're finitely lived. Hence, they somehow need to acquire an asset to bring consumption to the later period of life. And then there's two types of consumers. There's an early consumer and a late consumer. You can think of that a bit as a Diamond and Dybvig model, however, there's no uncertainty with respect to which type they are. So we have that these consumers, they work when they're young, and then they consume, then the early consumer consumes earlier, and then there's the late consumer who consumes later. And this early consumer will want to hold a medium of exchange, and the late consumer will want to hold a demand, a saving vehicle. Then additionally, there is a preference over public and private money. However, that's not going to be money in the utility. Instead, it's going to be that the agents, they demand a premium to hold private money over public money. And these premia, there's a distribution over these premia, so basically there is heterogeneous preferences such that some agents will want to hold public money and some will want to hold private money. So that's kind of this setup with the consumers kind of leads to a situation where there's a demand for private money, which will be deposits as a payment vehicle, private money that's going to be held as a saving vehicle, and also public money, so central bank money that's going to be held as payment and saving vehicle. And then, so what we have so far is that the entrepreneurs, they want to invest, but they don't have the good, and the consumers, the consumers, they can produce this good, but they need to have an asset. So the bank now here acts as an intermediary between entrepreneurs and consumers. What happens is that the banks, so the entrepreneurs, they go to the bank then creates a loan for the entrepreneur and credits the account of the entrepreneur. So the entrepreneur now holds deposits and can use these deposits to purchase the goods from these consumers. Exactly, so that's basically what the banks do. There is an assumption that there is a perfectly competitive deposit market and an imperfectly competitive loan market. So the banks in the model, they also have some market power. And then what's important here is that the banks are subject to a minimum reserve requirement constraint, and this is only true on liquid deposits. So this triggers that the banks actually have an incentive to offer two types of deposits. Why? Because the illiquid saving deposits, they can invest one-to-one into loans. However, the liquid transaction deposits, they can invest only partly into loans, and hence they want to offer two types of deposits. And as we've seen before, there's also demand for the two types of deposits by the early consumers and the late consumers. And hence, we will be in a situation where the early consumers hold transaction deposits and the late consumer holds saving deposits. So that's the basic setup of the model. I hope that's clear so far. So now let me explain to you what I think, how I think about the introduction of a CBDC. So for now, for this talk, I'm only talking about introduction of a non-interest-bearing CBDC. And similar to what Jorge said before, I'm thinking about a preference shift from private to public money. So the idea here is that maybe some agents have a preference of holding the safe government asset without counterparty risk, but they also want to pay digitally, and upon the introduction of a CBDC, they can now do so, so they might want to switch to hold the CBDC and maybe held bank deposits before. But basically, it's a switch from private money to public money, and if I think about a non-interest-bearing CBDC, I do not differentiate here between cash and CBDC, but it's basically just a switch from private to public money. So now I need to differentiate two cases. The first case is if the constraint is non-binding, so if the minimum constraint is if the minimum reserve requirement constraint is non-binding, such that the banks hold excess reserves, then there is no effect on bank lending. As we've seen before, the kind of idea is here that the banks in that situation hold kind of their optimal loan amount, and if there is a crowding out of deposits, what they will do is they will adjust their excess reserves holdings. So this result is more or less straightforward. Now, what's more interesting is if the constraint is binding, so if the banks do not hold excess reserves, that's illustrated in this table. So let me guide you through this table. What I'm thinking about here is a shift from private money to public money upon the introduction of the CBDC. That then leads to a situation where a lower fraction of agents holds deposits. That's this alpha D. So the alpha D is the fraction of agents holding transaction deposits. So here I'm only thinking about a shift from transaction deposits to CBDC, which triggers that a lower fraction of agents holds transaction deposits. So kind of straightforward, what happens is that on the extensive margin, the transaction deposit amount decreases, right? Quite straightforward. However, there is no extensive margin effect on the saving deposits by assumption for now. And then what's happening is that, the result that we've also seen so far in the literature, that there is a increase in the interest rate on transaction deposits. However, since now we have two types of deposits, there's also going to be endogenous increase on the rate on saving deposits, which then triggers an intensive margin effect on transaction deposits and on saving deposits. So on the intensive margin, the people still holding deposits will increase their deposit holdings on transaction deposits and on saving deposits. And now I find that bank lending always decreases. However, since we have this compensating effect on saving deposits, it might be that the effect on bank lending is actually not that big. Then additionally here, the second row is if we have both, if we have a preference shift from transaction and saving deposits to CBDC. Now additionally, we have this extensive margin effect on saving deposits. So we might expect that the effect on bank lending will be stronger. So in the model, it's hard to get a number out of how strong these effects are going to be. So that's why I'm going to do the calibration, which is what I do next. So I calibrate the model to the US economy from 1987 to 2006. I'm going to choose this time period because I want to match the model to the binding case, because as we've seen before in the non-binding case, the results are quite straightforward. I consider only cash that's held in the US because we know that a lot of banknotes are held abroad, and I kind of want to make a domestic analysis. I assume that the $100 bills are used as savings and all smaller bills are used as a payment vehicle, because I then use that to match some fractions of agents holding transaction deposits versus agents holding cash as a payment vehicle, etc. And I'm not the first one who makes this assumption. Also the BIS in some statistics does that. Then the data is for bank data, I use FDIC call report data, and for more straightforward time series as GDP, etc., I use FRED data. So I'm just going to show you one graph for today. Here on the left-hand side, what you see is on the x-axis is this fraction of agents holding deposits. So that's basically an endogenous variable, but I just felt like it's more intuitive to see that. So what you need to think of is that we have a preference shift from private to public money that then triggers a shift in the fraction of agents holding deposits. So here is the calibrated equilibrium, and if we go to the left, then that basically means that we have a preference shift from private to public money, which will decrease the fraction of agents holding transaction deposits. So now, here this straight black line is going to be transaction deposits, and we see as in the analytical part that transaction deposits will decrease if there is a lower fraction of agents hold transaction deposits, which is quite straightforward. But now what is interesting is that the saving deposits amount, they will increase because we don't have an outflow on the extensive margin, but on the intensive margin, people will hold more saving deposits because the interest rate is going to be higher, right? And this outflow, increase in saving deposits compensates the outflow in transaction deposits, and hence the effect on bank lending, which is here on the top, is not that big. And to put some numbers here, if we go from the calibrated equilibrium to this minus 10%, which means that there is a preference shift such that 10% of the agents holding transaction deposits switch to the CBDC, then bank lending decreases by about 1.2%. Now here on the right-hand side, what we have is both a preference shift in transaction deposits and saving deposits to CBDC. So what we see is that transaction deposits and saving deposits decrease now, which then in turn means that we have a stronger decline in bank lending. An additional observation that we can make is that the decrease in transaction deposits is not as big. It's not as big as it is here. In that case, why? Because the banks will increase their interest rate more to compensate for the outflow. So here, if we go here from the calibrated equilibrium to the minus 10%, which means for both transaction and saving deposits, 10% of the agents switch to CBDC, then the effect on bank lending is about a decrease, is a decrease of about 3%. Yes, so I have 1 minute left, so that should be good in time. So to conclude, I built a general equilibrium model to analyze the effect of a CBDC on bank intermediation. I differentiate the effect whether the CBDC is used only as a payment or also as a saving vehicle. And I find that there is no influence on CBDC on bank lending if banks hold monetary reserves. However, if they do not hold excess reserves, then there is going to be an effect. I've just told you the numbers before, and then in the paper, I'm also going to do some additional analysis. What happens if the central bank starts to pay interest rates? And yeah, I'm going to do some other things. Yes, and yeah, I guess to conclude, I also want to highlight, kind of as a policy conclusion, if the central bank kind of cares about the effect of the CBDC on bank intermediation, then should really be careful about thinking of the design to make sure whether people will start to hold it only as a payment vehicle or also as a saving vehicle, because we see that the effects are quite different. So thank you very much for listening.
It's a very interesting presentation. Let's give the floor to the discussant, then maybe open to general questions. The floor is yours.
Okay. So yeah, I'm going to discuss the paper we just saw. So yeah, thanks again to the organizers. This was a very fun to read paper. I think it has a lot of potential. So I'm going to describe very briefly what the paper does. I'm just going to summarize so as a quick recap on what Remo just told us. I'm going to summarize the main ingredients of the model, and then we'll give some comments. So I will have 3 main comments that I will present in order of importance, just in case I don't have time, and some other minor comments that perhaps we can just discuss bilaterally, and then conclude. So the paper, as was clearly shown before, is going to analyze the effects of the interaction of CBDC, mainly focusing on bank intermediation. And the main focus of the paper, as suggested by the title, is going to be the heterogeneity in deposits of commercial banks. And then what is the role of CBDC, I mean, and how is what are the effects of the different design options of CBDC in terms of its use as a payment vehicle versus a saving vehicle in the effect of this interaction of CBDC. So one of the main contributions, apart from this very, I would say, clever modeling of the heterogeneity in deposits, is then the quantification of the macro effects. And most of my discussion is going to be focused around that quantitative part. But the main takeaways, as we just saw, are that the design of CBDC and also the whether we are in an excess liquidity regime or not are going to be key for assessing the effects of these effects. So very brief summary of the model. There's going to be different agents that do not necessarily produce in the same period in which they want to consume, and therefore they are going to need to hold different liquid assets in order to move resources from one period to another. So there will be 2 types of consumers. The impatient ones that want to consume today, they will use what you can think of as demand deposits. Whereas patient consumers want to consume in the future, they are going to use time deposits. And there's this segregation in terms of the type of instruments they use in order to save. Now, bankers are going to be the ones issuing these deposits demanded by consumers, and they are also going to be lending to entrepreneurs, also subject to minimum reserve requirement constraints set by the central bank. Now, entrepreneurs, as I said, borrow from banks, and they do so in order to produce consumption goods. And the central bank is the agent that is going to set what are the reserve requirements and then the remuneration rate on these reserves, and it's also going to issue cash and eventually CBDC when it is introduced. So there's a coexistence of public and private monies with imperfect substitutability across each other. And the interaction of CBDC is going to be modeled as a shift, as it was explained, in the preferences for public versus private monies. And the design characteristics of CBDC is what is going to determine whether only impatient consumers that use demand deposits as a payment vehicle are going to be demanding CBDC, or also patient consumers that use time deposits are going to be replaced, are going to be replacing their commercial bank deposits for the digital currency issued by the central bank. So whether, so this design is going to basically consist of whether CBDC can be used as a payment vehicle or a store of value. Now, the main results, to finish with the recap, is that the interaction of CBDC is going to reduce bank deposits because some of the agents substitute from their previous demand of commercial bank deposits to this newly issued CBDC. And then there are 2 cases. In a situation with excess reserves, the drop in deposits is matched 1-to-1 with a decrease in central bank reserves. So then there will be no effect on bank lending. But if the reserve requirements are binding, the drop in reserves is going to reduce credit supply with with a contraction in output. And this effect is greater if CBDC is not only used as a payment vehicle, but also as a store of value. Now, my comments are, so the first one regarding the quantitative results. I would say the qualitative results are very intuitive, and I think the author does a very good job in having closed-form solutions and very intuitive expressions for what are the qualitative effects of the interaction of CBDC. But I think some of these effects could also be present in a simpler model, say 3-period model of a standard model of banking, where you model these agents consuming at different periods, but not you don't necessarily need a complicated model with dynamics and so on. So I think the main contribution, and I think this is something you emphasize you correctly emphasize in the paper and also in your presentation, should lie in the quantification of these effects. So the added value of having this model is in order to be able to quantify. But then, if that is the goal of the paper and one of the main contributions, then I think calibration has some room for improvement. So there's a set of parameters that is conventionally set to external values used in the literature, but then there's also the parameters that are jointly calibrated to match some empirical moments. Here, if my reading is correct, the number of parameters was larger than the number of empirical moments that you try to match. And then it is not clear that this can be, all the parameters in your model can be correctly identified. So I would suggest perhaps either taking some of these internal calibrated parameters to the external calibration, or finding a larger set of empirical moments so that you can correctly identify all parameters. And then it would be useful to have some parameter sensitivity analysis, either just, more of a narrative approach in which, you can more or less argue what are the parameters that target each of the moments, or a more serious quantitative approach in which you analyze the sensitivity of each of these parameters. And I think a very useful reference is this paper by LNF and co-authors that was recently published, that they take calibration very seriously, and I think in the macro banking literature, this should be perhaps the standard. So this is my suggestion to perhaps improve a little bit the quantitative part. Now, the second set of comments is regarding the banking sector. In your model, the key constraint is the reserve requirement. However, banks currently hold excess reserves, way above the minimum requirement, as you know. So perhaps more relevant constraint would be equity-related constraints that are absent in your model. I think this could be perhaps more relevant. So the way these constraints would interact with your effects is that the introduction of CBDC may decrease bank revenue from issuing deposits, say if banks had market power in the deposit market. Then changes in bank profitability affect equity accumulation and the constraints related to this. And a decrease in bank profitability would also affect other aspects that are not in the model, but that could be important perhaps, so bank entry, risk-taking, all these elements that are perhaps typical in the banking literature. So I think it would be perhaps a little bit unfair to demand you to include more ingredients in the model, that given some of these elements are also absent in other papers on the CBDC literature, including ours, the one that I just presented. But given the focus on the effects on bank intermediation in particular, I think it could be worth exploring at least some of these additional dimensions. So this is more of a suggestion for you. Now, to conclude with my last comment, and the other ones I will just I will send you the slides. We can discuss after the presentation. But I think modeling of the asset side of the central bank balance sheet is mostly neglected. You acknowledge this in the conclusion, so this is perfectly fine. The implicit assumption in the model is that the central bank invests in a storage technology with zero net return. So interest payments on its liabilities have to be paid for via raising taxes in the consolidated budget constraint of the government. But in reality, central banks do invest in other assets or provide funding to banks, or, we've seen some of this in the previous presentation. So if the central bank could increase the match in its liabilities via the increase in demand for CBDC with, say, for instance, lending to banks, it could compensate for the loss of deposits. This is basically what we had in the model that I presented. And I think this is the main reason why our results on the effects of bank intermediation differ. In your model, banks cannot compensate for this loss in deposits, but you could think of a scenario in which the central bank targets back these funds to banks. And this is related to the equivalence result in Brunermeier and Nippelt. There are some other comments, but I will not emphasize this in the presentation. Just let me conclude saying that the topic on which the paper elaborates is very relevant for policy discussions. I think it has a lot of potential to be a very important reference in the literature. So my comments about the quantitative part don't take this as a criticism, because I think there's a lot of potential if you could just, I mean, the qualitative part I think is excellent, and perhaps it is the quantitative one that is a little bit lacking. So I think with a little more effort, this could turn out to be an excellent contribution. So yeah, thank you.
Thank you for your discussion. I would open the floor for questions if there are. Yes, please.
Yeah, I was just wondering if you could tell us more about exactly so you mentioned you don't have money in the utilities. What exactly do you have? Can you be a bit more precise? And especially what's driving the inelasticity and in which direction between the different periods? That would be useful.
Is there any other question? Yes.
Thanks. So I didn't quite get the intuition why the effect of the substitution of savings accounts on lending is larger than the effects of payment accounts on lending. So you said it 3 times. I guess I can kind of think about it, but I wanted to have, to know from you whether it's a result of the calibration or perhaps there's some qualitative intuition for why there is in the model.
Thank you. Maybe one more question and then the author can answer. If not, I will just ask again, which is probably in tune with previous question. I didn't quite catch what is really special about CBDC in this model. So what triggers the substitution from one type of asset towards the CBDC in the balance sheet of households?
Thank you very much for the question, and thank you very much, Jorge, for the discussion. That's very helpful. So I'm going to go first answer these questions. With respect to the quantitative part, I take the criticism. I will have a look at it again. I'm not sure about the 11 parameters. I thought a lot about matching the moments, but maybe, yeah, I need to. I did it quite some time ago, so I need to look at it again. It's a fair point. With respect to the reserve requirement constraint that it's not binding at the moment, yeah, that's totally true. But also with respect to your paper, when we think about it, CBDC could crowd out these deposits, then we might think about that we end up in a situation where it binds again, and then we will be in a situation where it's relevant again. So I think it's still relevant to think about the effect of its binding. But yeah, I agree that I could introduce like equity constraints, etc. Yeah, I might think more about that as well. And the asset side of the central bank, that's totally fair point. Normally in these models, people don't really care about the asset side of the central bank, which I think is a big weakness. That's why I really was careful about not making GDP statements. And also I do like some welfare statements, but not like I do not emphasize them too much. But since I really focus on bank lending, I think, yeah, it's still possible to make these statements, except if we think about the Brunner-Meyer-Niepold equivalence result, but I kind of abstract from that and say, yeah, if the central bank does not do that, then what are the effects? Yeah, thanks again for the discussion. Then the preference, the slides are gone already. Let me first answer the other questions, then maybe I can show it to you on the slides, because I have it in an appendix. Okay, perfect. So how I model it is that, so as I said, they draw basically a premium over a premium that they demand to hold bank deposits over or private money over public money. So you can think of it like that. So there is this premium epsilon, and this is the interest rate on central bank money, and this is the interest rate on private money. Now, the agent draws an epsilon and will hold deposits if the interest rate of deposits is higher after taking into account his premium. Then what you have then, and that's the same is true for saving deposits. Yeah. Yeah, I mean, it's not standard that I put this classical money utility function there where you have this specific parametrical form. At the end, what's nice about that here is that there will be also effects depending when the interest rate change, right? If the interest rates, for example, on deposit increase, then some agents will also switch back, etc., to deposits because they care about the interest rate differential basically between interest rate on the transaction deposit, interest rate on deposits, and interest rate on central bank money. But yeah, I mean, do you want to see more? Was that okay? Good. Yeah, let's discuss later. Then why is the effect on savings larger? So what I highlight in the results when I talk about this 1.2% and 3%, it's mostly about if there is an additional crowding out of saving deposits. I also look at the case where there's only a crowding out of saving deposits, and then the effect is bigger. And I think it's mostly also because basically there is more, like the deposit amount is bigger, right? If you look at the total deposits, then there is a higher outflow of deposits. Then we need to think more about the elasticities, and I actually don't remember the numbers, but they were not that different. So it's mostly driven by that we have additional deposits that are going to be crowding out. I just want to highlight that part that, okay, it's not enough to only think about one type of deposits. What's special about CBDC? That's actually a valid criticism because you could also think of it as a preference shock from private to public money, and it could also be something else. I don't know, people suddenly, we go in a very serious shock that people don't trust banks anymore, and they start to hold public money instead of private money, and then the model would still hold.
Thanks for having our paper in this session, and thanks for my 30 discussants on the floor. Okay, so I look forward to your comments later. This is joint work with Harald, who needs no introduction, and I'm from National University of Singapore. So there's a bracket of digital in the title because we are still hesitating whether we want to include this word in the title. Because whenever we send out for review and the reviewer keeps criticizing, so what's so special about the currencies here? And yeah, we will see. Okay, so the motivation here is the increasing variety of different currencies, including your privately issued Bitcoin, Ethereum, and also nowadays with central bank digital currencies, which is on the rise. And there are also stable coins. So in a way, we have a lot of currencies circulating simultaneously in a country. And the question here is that, so there have been many papers talking about using these currencies as medium of exchange or the transaction convenience and so on. But a phenomenon that's starting to appear is that alternative currencies are becoming the counting units, although it's not very prevalent now, but maybe it's going to be a thing in the future. So for example, some companies have started to selling things in terms of Bitcoin. So recently, or not long ago, we saw that Tesla tried to price their cars in Bitcoin, and also some of the smart contracts often pay off in underlying digital currencies. So let's say in the earlier ICO phases, when the startup try to issue new coins, they price them in terms of Ethereum and some other kind of platform currencies. Right, and also in some countries, Bitcoin are becoming the legal tender, which means that the seller can actually accept those alternative currencies. They can even try to price them in terms of those currencies. So question is that what happens if the firms try to use these currencies as pricing units? So instead of selling an iPhone in 1,600 euro, maybe I price it in terms of 1 Ethereum. So what happens in this case, what will happen to the macroeconomic dynamics? So that's the key things that we want to analyze. So pertaining to the role of money, this paper is on the unit of account. meaning we use that as counting units for firms to actually count the profits, to count the revenues for whatever things that turn sell. So we are not interested in the medium of exchange or store of value functions. So unit of account is one of the key things that we want to discuss. So, and then we have key shocks in the model in this environment, which is the exchange rate shock. So this is common nowadays, especially after those stable coins incidents. We know that even the most stable coins can have an exchange rate shock in their value, or the exchange rates against the dollar. And also another issue is that the firms will try to price their products infrequently. So this is the usual cowboy pricing or sticky price setting. So in order to approach, to analyze these things, we use a new Keynesian model with multiple currencies. So we basically augment a basic new Keynesian model to include many currencies in that model. And then firms try to fix prices in one of these currencies available. And currencies are actually perfect substitute as a means of payment. So we are not interested in medium of exchange. So we simplify the setting for the payment choices, whereas we focus solely on the pricing choices of the firms. And we also look at the central bank's perspective, whether, I mean, from a central bank's perspective, when they try to decide their Taylor rule, whether they should target the dollar sector or they should target all the currency sectors, and whether the dollar sector's output should be targeted or for all the sectors' outputs. Okay, so just a simple overview of the results. One of the key results we have is that the exchange rate shocks can arise without other sources of uncertainties. So I will show you very shortly. And the second key result is that the relative price between the sectors, they'll become a state variable in the new Keynesian framework, meaning, so the relative price is an autoregressive process and is driving the dynamics in different sectors in the economy. And there will be sectoral reallocations across the currency sectors. And the third key results will be during the endogenous currency choice. If we give the firms a chance to choose another currency when they are given a chance to reprice their products, then there will be an ambiguous effect on the non-dollar sector size or the dollar sector size. So the sizes of the sectors in different currencies will change, but in an ambiguous way. Okay, so there have been quite a lot of recent literatures, but some of the classic ones would be the Galo's new Keynesian models, and also one of the more relevant papers would be the Gopinath papers on the local currency pricing and producer currency pricing in an open economy setting, but we are doing it in a closed economies or in one country setting. So just to try to illustrate the model, at first, we have firms that's located in the interval between 0 and 1, so that's the continuum of firms indexed by I. And we have different currency sectors. So firms that price in dollars will be in sector 1, and then firms priced in Bitcoin, Ethereum, and all the other currencies will be the other sectors. So sector 2 and sector 3, depending on how large the sector is. Initially, we fixed the sector sizes, meaning, for instance, we'll impose an exogenous size, let's say 80% of the firms will price in dollar, and 20% of firms will price in all the other sectors altogether. And subsequently, we try to extend the model by allowing the firms to actually switch the currencies. So meaning when they try to, they are given a chance to reprice their products, they can also choose another currency which they want to use as the pricing unit for future, right? So that leads to a varying sizes of currency sectors across time. Okay, so this is some introduction to the model. We have J currencies in total, so J can be any number, an infinite number, and each with money supply MJT. So without loss of generality, we can say that the first sector is always the fiat currency sector, in which the firms will price in dollar. And whenever J is not 1, then we say this is a parallel currency. It can be Bitcoin or Ethereum or any other stable coins. And EJT will be the exchange rate for currency J, which is the price of currency J in terms of dollar. So by definition, the first sector's exchange rate will be 1. And firms in sector J will set prices to PJT in currency J, but they will also accept payments in all the other currencies at the prevailing exchange rate. And each sector has its own sets of firms and its sizes. We fix the size, we fix the sector size for now, and we make it endogenous later on. So households has a standard utility function or money in utility function with consumption and liquidity and labor. So the liquidity is a linear summation of all the liquidity in different currencies converted to a standardized numeric currency, which is and then labor supplies and so budget constraint, the consumers will consume consumption and buy some bonds and hold some liquidities, earning interest from the bonds and also earning from the exchange rate changes and also income and profit from the firm. So that's the, great, thanks, standard one. From firm side, it's also a simple production function with 1 minus theta j fraction of firms reset prices in sector J. So when firm tries to maximize its profit, when it's given a chance to reprice its product, it has to consider the future dynamics of its exchange rates and also demands. So, so that's also similar to the cowboy pricing, except that we have to consider the exchange rate dynamics in the firm's decision. So the important price indices are the sectoral prices, which are the aggregate of all the prices in that sector, and also the aggregate general price, which is the sum of all the weighted average of all the sectoral prices. And there is a relative price, which is the price of sector J to over the overall general price index. So this is going to be one of the key state variables that we are going to see in the subsequent results. So one of the first results derived from the linearized model is a simple random walk for all the exchange rates in this country. So it's a random walk process as derived also by Currican and Wallace and Schilling and Uhlig's paper. Right, so this is a simple result which gives the stochastic component in this model because there's no other sources of macroeconomic uncertainties. Simply, so this simply generates from the exchange rate movements or preference for different currencies in this country. And sectoral NKPC, as we derive from the model, is augmented with a relative price term. So the standard one is without this relative price, and now we have a relative price term, which is relying on the previous period's relative price, and also the inflation in that sector, and also the exchange rate shocks. So this is the new yes, but. Mm-hmm. This is with okay. You can interpret it. This is with dollar. Yes. Yes, dollar, Bitcoin, and dollar, and all the other currencies. Right. Okay. And those are exogenous, independent of monetary policy. No, it's independent of monetary policy. Yeah. Right. 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 Okay. Thanks. We can have more discussion soon. All right, so the dynamic IS curve is a standard one, similar to the standard simple 3-equation model. Okay, so if we put everything together, we can see that we have a 2J plus 1 equation system for the New Keynesian framework, the linearized New Keynesian framework. Basically, for equation 2 here is a vector equation with J inflations in inflation rates in all the sectors, and also for equation 4, we have a vector of J relative prices in all the sectors. So you can see that whenever there is an exchange rate shock in any of the sector, it leads to 2 changes. Number 1 is the price level in that particular sector, in that particular currency sector, And then number two is that the exchange rate shock will lead to a change in the general price level, which we converted to the dollar terms. So the changes will mean that one single exchange rate shock in one sector will lead to the changes in all the relative prices in all the sectors. And that leads to a dynamics in all the inflation rates in different sectors, and hence the output gap. And depending on the interest rate, we will see different macro dynamics. Right, the general aggregate inflation will then be the sum of all these inflations in different sectors. Okay, so some of the theoretical results that we derive is that first, the optimal prices in both sectors are equivalent. So this is parallel to Gopinath et al.'s paper on local currency pricing and producer currency pricing. And the second one is that whenever you take two sectors in the country, the relative price between these two sectors will always be an autoregressive process given an exchange rate shock. And the inflation differential and also output gap differential will also be the function of the relative price. So this means that the differential between any two sectors in output gaps and in inflation rates, they are independent of the monetary policy. So they are solely depending on the relative price dynamics here. And also if we assume, okay, thanks. Also if we assume the homogeneous rigidity, we can see that once we sum up all the inflations in all the sectors, it becomes a very simple Newton's and Phillips curve with an augmented exchange rate shock. Okay, so in terms of monetary policy, we specify like three specifications where the central bank can try to target. Number one is the central bank can target the aggregate inflation and aggregate output. It can also try to target dollar inflation and aggregate output. And it can also target dollar inflation and dollar output. So these are the three choices that we have, and some of the numerical numbers that we put in. So the baseline policy is an aggregate inflation and aggregate output targeting. We can see that once we derive the linear the functions for interest rates, output, and inflation in terms of the exogenous shocks, these functions become a linear function of the exchange rate shock alone. So we can see that the aggregate output and output gap inflation and also the nominal interest rate, they are just one-off changes. But if we look at the sectoral output, there are actually some real occasions here, because once we see an increase in exchange rate, which is a depreciation of dollar, then we see that the output, actually, the demand actually shifted towards the dollar sector because the firms had no time to adjust their prices, and a depreciation leads to a cheaper goods in the dollar sector and a more expensive goods in the non-dollar sector. So the demand shifted to the dollar output, and the prices actually starting to go back to before the price go back to the equilibrium, to the steady state. Right. So this is the reallocation effect between the different sectors due to an exchange rate shock. And we also have two other specifications where the central bank can try to target the dollar inflation, and together with either an aggregate output or a dollar output. So as we derive the policy functions here, we can see that the aggregate output now becomes a function of the relative price between the two currency sectors. So the relative price is actually a persistent process, a persistent function, because it's autoregressive. Firms do not have enough time to adjust. So it becomes a smooth or persistent variable, which leads to a persistent decline in the output gap, and also a persistent changes in the dollar sector inflation, and also the interest rate. And the aggregate inflation would just be a dollar inflation plus the non-dollar inflation together with an exchange rate shock. So we'll see a spike here, followed by a persistent change at in the subsequent periods. Okay, so in the interest of time, I'll jump to the currency choice. So as an extension of model, we assume that the firm has the choice to change its currency, and also and whenever it can reprice its product, it can change its currency as well. So in this model, we use a McFadden's discrete choice model. So firms will try to choose a currency J that's the highest among all the other currencies. And therefore, the probability of pricing in a particular currency J will follow a distribution like this. And then we have a more law of motion for the size of the firm. We want to see how the sector size will change according to following a change in, for instance, a stickiness in the model. Okay, yeah, just give me a few minutes. I have no, yeah, okay. All right, so the key equation here is that the sector size for the non-dollar sector, when the dollar sector becomes more flexible, is this function. So there are two opposing forces here. We can see that we have the remaining firms that could not reprice in the previous period in T-1, which is theta 2, and then we have firms who can price, who previously priced in dollar and now switch to non-dollar sector, and we also have firms who previously priced in non-dollar but choose to continue to price in non-dollar. So that's the key law of motion for the sector size for the non-dollar, but there are two opposing forces here. So if a sector becomes more flexible, for instance, the dollar sector becomes more flexible, then that means there will be more firms wishing to price in dollar, and we will see a declining probability of pricing in non-dollar. But at the same time, it also means that the more dollar firms, they can try to switch their pricing currency. So these two forces actually lead to a decreasing value of P2, but an increasing value of 1 minus T1T here, and then we can see different ambiguous results here. So the insight from here is that the resulting currency sectors will depend on which force is actually stronger. And we try to compare different pricing cycles. For instance, the dollar sector can price in every 2 quarters, 3 quarters, or up to 5 quarters. They are actually not monotonic in this case. So for instance, we have 2 quarters, and now the steady state is 20% of firms pricing in non-dollar. But once the dollar sector becomes more flexible, where firms becomes less flexible when the firms can price in every 3 quarters, then we see that the non-dollar sector has declined slightly. And this is slightly clear. So we try to simulate the relationship between the probability of pricing in a different currency, an alternative currency, when the dollar sector gets more and more sticky. So you see that the probability of pricing in the non-dollar sector, in the alternative currency sector, gets higher when we have a more sticky dollar sector. But the eventual size of the firms, depending on the two opposing forces, we'll see that at first, the non-dollar sector will increase, but subsequently because the dollar sector gets more and more sticky, less firms can actually escape from the dollar sector, and we'll see that the non-dollar sector size actually decrease in the more sticky scenarios for the dollar sector. Okay, so these are just some additional results we can discuss further. But let me just conclude here. So this is motivated by the increasing number of currencies. So we asked the question whether when firms price in these alternative currencies, what will happen to the macroeconomic dynamics. We use a simple New Keynesian model, and without any discussion on the technological aspects of digital currencies, and that's why we get some criticisms on the digital aspects. But the results is quite interesting, and we'll show that there have been persistent reallocation between the sectors, and also the relative price between the sectors are state variables for the New Keynesian framework. And when firms can choose their currencies endogenously, then there is actually an ambiguous effect on the sizes of the currencies, right? So that's all, and I look forward to comments.
Thank you very much for the presentation. Are there comments from the audience or questions? Okay, I wanted to start.
I mean, I have a question about the welfare effects. No, it looks like the optimal here is not to have any other currencies than the dollar, but maybe I'm wrong.
Okay. Right.
So a very related question, actually. I was wondering, I didn't get in the extension what's the force that prevents everyone from coordinating into using only the dollar as the currency? And then kind of related, I'm wondering, like, can you give us an example of a firm that is pricing, that actually quoting price, mainly in a cryptocurrency as compared to US dollar and not doing just a conversion?
If there are not other questions, I might add one
Okay.
question/comment. There is a paper from Dimitri Mukin that came out in the IR recently, which does something similar. The flavor is different, but there are also many similarities. They also start from a pricing equation with sticky prices. And they look exactly at this question, why we see multiple currencies, why one currency dominates, etc. And there the key thing was the volatility of the exchange rate, which speaks a lot to your shock in the model. And the finding was that in the long run, firms tend to coordinate on the currency that has the lower volatility of the exchange rate. And I was wondering if you have something to comment of if your model can speak to some of these results, or not. Obviously, they're different models, so but there are similar things as well.
Okay, all right. Okay, thank you. Yeah, thanks, Frank, and this friend's question. So I think both of the questions are quite similar in terms of why there isn't a aggregate switch to dollar pricing. I mean, it has to be. I mean, we have a setting here which we have a McFadden's discrete choice, which means that there is always a certain percent of firms who tries to price in a different currencies rather than dollar. So it's like in any case, there is always someone who wants to do like trafficking in terms of in cash and also in Bitcoin in the past. So so we give some allowance that there is always someone who do not want to go for the mainstream choice currencies, and that leads to the result that in the long run there's a non-zero proportion of firms who tries to price in a different currency. Right. So yeah, the second question. Okay, as for the example of Bitcoin pricing, and so far I can't give a very exact question, but the only more prominent example that I know of would be the Tesla's example. But they are probably trying to price in dollar, but try to and then convert to Bitcoin, and maybe they try to collect more Bitcoin and for their future investments. But it's just we are just trying to envision a futuristic scenario when the dominance of the cryptocurrencies or even the stable coins become stronger. There could be a situation when the firms can try to price in a different currency rather than in the dollar. So yeah, so as of now, it's hard for me to give an example now. Yeah, and then Massimo's question. The sorry, could you just
in the international literature, there is this kind of old knowledge that one of the reasons why the dollar dominates is because the dollar is very stable. No?
Yeah, okay.
And there is this paper that came out recently from Dimitri, which shows this analytically, essentially starting from a pricing equation like yours, where there are sticky prices, and then it is linearized as second order. Obviously, the volatility pops up in the solution, and it is shown that it is optimal to pick the currency in the long run, so in a kind of steady state, no, which has the lowest volatility of exchange rate. And I was wondering, in your modeling, it is very clear the exchange rate shocks and the role that it has as an engine of the model. And I was wondering if you could have some similar results, which in turn would imply, that many of these crypto assets that are out will need to work a lot in reducing the volatility of their price if we would reasonably want them to use as unit for payments because you know they're so volatile.
Yeah. Understand. Okay. Yeah. Thanks for the question. It's a very interesting question. So it pertains to like the future volatility of the exchange rate. So in this model, it's hard to model that because we have a result that is a random walk process. So whichever future volatility will be gone, it's just a one-off process, and the expected exchange rate will always be constant in the subsequent period. So, I mean, maybe we can try to add some features in the model. But it's a good question to consider for a future development in this field, right? Okay, thank you very much.